Okay, so if you've been keeping an eye on financial news, this whole conversation around real-world asset tokenization, it's really heating up. We're talking about moving things like U.S. treasuries, big corporate bonds, even huge real estate portfolios onto the blockchain. It's not science fiction anymore. It's actually happening. But, and this is the big but, there's a massive bottleneck, right? These traditional assets, they come with decades of rules. Think regulatory oversight, compliance needs, settlement demands, things most public blockchains they weren't built for.
Exactly. They were built primarily for decentralization, maybe speed second, regulation, often an afterthought if considered at all.
Not exactly Wall Street ready.
Not at all. And that's the crucial point. When you're seriously talking about bringing trillions of dollars in real world assets onto a distributed ledger, well, you need a very specific kind of architecture. You need a foundation that's built from the ground up with audited compliance and institutional integration baked in. So that's our mission for you today. We're going to do a deep dive into the sources discussing Metal blockchain, ticker Metal. They claim to have cracked this exact problem. We'll unpack the 5 key characteristics mentioned in the material that supposedly make it the perfect fit, the compliant, scalable backbone for this new era of regulated digital finance.
All right, let's get into it. Where do we start? Focus One seems really unique. It's about this institutional ecosystem, specifically built around credit unions and community banks. That sounds different.
It is different. And honestly, it's probably the most, let's say, audacious part of their strategy. Metal isn't just going after the huge mega banks. They're deliberately targeting the highly localized, community-focused financial engines.
Interesting.
And here's the twist. They don't just want these institutions as partners on the infrastructure. They want them to actually own their piece of the infrastructure.
Own it. Wow. Okay, that is a powerful distinction. The sources really hammer this point home, allowing established players like credit unions, local banks, fintechs too, to launch their own branded Layer 1 networks and their own stablecoins.
Exactly. It's not just like a white label service or SaaS platform. It's pitched as genuine sovereign infrastructure ownership.
Okay, but hang on. Wouldn't that be a massive headache for, say, a smaller credit union? All the regulation, the operational complexity of running your own Layer 1, why take on that burden instead of just using an existing public chain?
That's where it shifts from just being technically interesting to being strategically necessary. It sounds counterintuitive, but owning their Layer 1 actually simplifies compliance for them.
How so?
Because they control the network's rules directly. They can programmatically build in KYCM checks, enforce specific jurisdiction rules, guarantee the kind of instant settlement their regulators require. The compliance burden is eased because it's embedded in the protocol itself, not managed by some external off-chain process.
Okay. So the control actually reduces the external compliance work.
Precisely. Plus, think about the scale involved here. Community banks and credit unions collectively hold enormous balance sheets. They're just often fragmented. By making it easy and crucially affordable for them to spin up these compliant chains, Metal is essentially positioning itself to aggregate all this previously disconnected local liquidity. That's a key step if you want to unlock those trillions in potential value everyone talks about.
Right. That really reframes the credit union focus. It's less about individual size and more about tapping into a vast distributed network.
That's
clever strategy. But okay, once you've got these institutions on board, they're dealing with high value assets. That immediately brings us to the technical side focus too. Performance and certainty.
Yes.
Because if you're tokenizing something like U.S. treasuries or, bundles of mortgages, you absolutely cannot have settlement delays. You need rock solid certainty that a transaction is final. Instantly final.
Speed and finality, they're completely non-negotiable in institutional finance. It's table stakes. When a transaction happens, a bank needs to know with absolute cryptographic certainty that the asset has moved, the payment is secure, and crucially, that transaction can never be reversed or double spent.
Right.
Think about the difference maybe between using your credit card where the payment shows as pending and the money might not actually settle for days.
Yeah, that lag.
Versus physically handing someone cash. Instant finality, which Metal claims to offer, is like the digital version of that cash handover. It's immediate, irreversible proof of settlement that's vital in regulated spaces.
So if a big bank is trying to settle a huge cross-border trade, or maybe handle a margin call in a volatile market, waiting even a few minutes for a block confirmation, that could be disastrous. It could spill the deal or create massive systemic risk.
Exactly. So what benchmark do they need to hit? They need to beat the existing systems, things like Fedwire, which are reliable but still have constraints. By offering high throughput and near instant finality, we're talking under 2 seconds, according to the sources they aim to eliminate that settlement risk. It's not just about speed for speed's sake, it's about reducing counterparty risk. That's the language institutions understand as trust. Certainty, fast.
Makes sense. Speed and certainty are crucial. But fast settlement doesn't help if the asset itself isn't handled correctly from a compliance perspective, right?
Correct.
How do they deal with the messy reality that, say, tokenizing a mortgage involves totally different rules than tokenizing a stock or a commodity? Which brings us nicely to focus 3, tailored environments using custom chains.
Yeah, this is a really important piece. It gets back to the idea that not all assets are created equal, a phrase that pops up in the source material. Think about it. a token representing a fractional share in a specific office building in, say, Chicago.
Right.
That has completely different legal baggage, KYC requirements, property lien considerations, local laws than, say, a token representing a publicly traded share of a company.
Totally different worlds.
So Metal's solution here is using custom subnets. You can think of these subnets as like isolated, purpose-built lanes on the highway.
Okay.
A real estate group doesn't have to try and shoehorn its complex rules onto the same main chain that might be used for a simple stablecoin transaction. They can launch their own bespoke subnet. And on that subnet, they can enforce specific rules, mandatory KYC checks for all participants, maybe restrictions based on geographic location, specific accounting standards needed for that asset type. It's tailored.
So it's about partitioning the complexity.
Yeah.
Isolating it. If one specific type of asset runs into a regulatory issue, or maybe even a security breach on its subnet.
Exactly. It doesn't necessarily contaminate or affect the performance and integrity of the entire ecosystem. The risk is contained within that specific subnet.
That makes a lot of sense.
It allows for a really clean separation of concerns. Developers can customize everything for that subnet. Who the validators are, how gas fees work, even the governance model, all to perfectly match the regulatory needs of that specific asset class. This kind of deep customization is crucial if you want to satisfy different regulators around the world who all have slightly different requirements for control and auditability.
That flexibility sounds powerful, but usually that level of customization comes with a hefty price tag, which seems to clash a bit with the whole strategy of targeting smaller credit unions. So that leads us directly into focus 4, accessibility and competition through low-cost infrastructure.
Good point.
We know launching and just operating networks on some of the big established EVM chains can be incredibly expensive. Gas fees can go wild, right? It often prices out the smaller players entirely.
Absolutely.
So if the goal here really is widespread adoption by potentially thousands of community institutions, the cost of using this infrastructure has to be, well, pretty low, almost trivial.
It has to be. Think about those unpredictable, sometimes astronomical gas fees you see on certain blockchains during peak times. That model just doesn't work if you want thousands of banks processing millions of potentially low-value, high-volume transactions, which is a lot of what community banking involves.
Right, everyday transactions.
Metal is apparently engineered specifically to be accessible and affordable. The core idea is enabling competition. Making the infrastructure low cost helps democratize access to these modern financial rails. It means, in theory, that the local credit union down the street in Ohio can actually afford to compete, at least technologically, with the giant financial institutions in New York or London.
Okay, I hear the claim about low cost to launch, but let's push on that a bit. What about the ongoing costs? Transaction fees when volume really picks up. Does the model genuinely keep operational costs low long-term, especially if these tokenized assets become super popular and highly traded?
That's where the subnet model comes back in. Because institutions can deploy and effectively own their layer 1 via these subnets, they have significant control over their own economic model.
Control again.
Yes. They can optimize their specific subnet's cost structure. Maybe they prioritize extremely low fees for high-volume everyday transactions. Or perhaps they set slightly higher fees for specialized high-value services on a different subnet. The design allows for scaling volume without necessarily causing massive congestion and cost spikes on one single shared chain. That's key to maintaining affordability across the whole ecosystem.
Okay, that addresses the economic hurdle, which is definitely significant. But there's still the final and maybe biggest piece, convincing the regulator.
Always the regulator.
All the speed, the ownership, the low cost of doesn't mean much if the technology isn't speaking the language that traditional finance and its overseers understand. Which brings us to focus 5, the foundation compliance first design.
And this, I think, is positioned as perhaps the most critical differentiator in the source materials. It's made very clear this platform wasn't sort of adapted for compliance later on. It was apparently built from the ground up with compliance in mind. It's not presented as a feature bolted on. It's framed as the core operating system.
Built in, not bolted on. Got it.
2 specific elements really stand out here. First, just a deep fundamental alignment with regulatory principles. And second, very specifically, ISO 2022 readiness.
ISO 2022. Okay, that term comes up a lot. Can you just quickly define why that's so important?
Sure. Think of ISO 2022 as the emerging global standard for financial messaging. It's essentially becoming the new universal language, a Rosetta Stone, if you like, for how banks, exchanges, payment systems, everyone communicates financial data accurately and consistently across borders.
Okay, a universal translator for finance. Why does being ready for it right now matter so much for a blockchain?
Yeah.
Does this let it talk natively to, say, new central bank digital currencies or existing global payment systems that are migrating to this standard?
That's exactly it. By building in alignment with ISO 2022 from the start, Metal ensures that the data generated on its chains, the transaction details, the embedded digital identities, the asset information is structured in a way that's immediately understandable and compatible with the existing and future centralized financial backend.
Future-proofing.
Right.
It future-proofs the system for interoperability with large, regulated players, including potentially CBDCs as they develop. It also means they can embed a compliant, auditable digital identity framework right at the base layer. So if a regulator needs to look under the hood at a transaction, the information is already there, structured in a format they recognize and trust. This kind of preemptive design is central to the claim that it can serve as a compliant backbone for the US and even global financial systems. Okay, let's pull this all together then. We've looked at these 5 pillars defining Metal Blockchain's specific strategy for RWA tokenization. We started with that distributed power of the institutional ecosystem, focusing on credit unions and giving them ownership. Then we covered the absolute necessity of high throughput and instant finality for financial certainty.
Crucial.
Followed by the tailored control offered by purpose-built subnets for different asset types.
Right, that customization.
Then the market-enabling aspect of low-cost infrastructure, making it accessible.
Democratizing access.
And finally, wrapping it all is that foundational layer. Compliance-first design, especially that ISO 2022 readiness.
Exactly. So the bottom line, if you synthesize all the source material we looked at, seems to be this. Yes, RWA tokenization is likely going to be huge, maybe defining the next decade of finance, but the real make or break factor won't just be if we can move assets onto ledgers, but which specific architecture is actually built correctly and compliantly to be allowed to handle it at scale.
And the claim here is that this particular mix, combining that local, community-based institutional adoption with adherence to global regulatory standards like ISO 2022, uniquely positions Metal Blockchain. They're aiming to be the foundational layer for tokenizing potentially trillions in these real-world assets. It's a mind-boggling number, but the argument rests on successfully aggregating global value, but doing it through these trusted local channels.
And that really is the unique strategic angle to chew on. If Metal can actually succeed in bringing thousands of these local credit unions and community banks onto compliant, affordable, customizable blockchain infrastructure, well, the whole scope of adoption changes, doesn't it?
How so?
It stops being just about migrating a few big, high-profile assets. It becomes about potentially aggregating millions of smaller, previously fragmented, maybe even illiquid balance sheets held at the community level, but doing it globally.
Okay, so we'll leave you, the listener, with this final kind of provocative thought to consider. If this platform really does manage to bring the global rulebook onto the blockchain, but does it primarily through community banking, could that mean the next truly massive tokenized asset class isn't some global corporate bond, but something much more hyper-local? Something previously locked away and inaccessible to the average investor?
Like what?
Maybe things like fractional ownership in community solar projects, or shares in regional municipal debt, things that were just too difficult or costly to access before. That question of accessibility at a local level, that's definitely something worth mulling over.